Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan, Cameron Mealy, and today we will discuss the latest economic news and also how our portfolios performed in August. Cameron, why don't you kick us off with the latest economic update?
Will do. Hello, everybody. Hope everybody's doing well out there. Kelly, we got a big week of everything. So today is Tuesday, September 10th. We have our first presidential debate this evening, and I'm sure there'll be some fireworks flying after that. We'll see how that goes. We also have Fed meeting coming up next week on September 18th, 17th, and 18th. And really, if you look at this week, we've got a bunch of information to digest, but this week we'll get new readings on the consumer price index and the producer price index. That will obviously lead to a Fed decision on interest rates. Many people are expecting on the 18th that the Fed will announce an interest rate cut. Not sure if it'll be 25 basis points or 50 basis points, but it does seem like the Fed, as long as we don't get something very unusual in these reports, it does seem like the Fed is on pace now to start cutting interest rates, easing a little bit. Don't know how aggressive they're going to be, but let's jump into the numbers that have led to really all of this. Let's start with GDP. On August 29th, the Bureau of Economic Analysis reported that according to its second estimate, GDP in the second quarter increased at an annualized rate of 3%. This is up from the advanced estimate we reported on last month at 2.8% and significantly higher than the 1.4% that came in the first quarter. Really, this GDP report, if you saw the market last week, it was pretty ugly. Lower employment numbers, but stronger economy really led to a sell-off. It really manifested itself into a stock market sell-off, lower treasury yields, and lower oil prices. Let's talk about what we're expecting for the third quarter for GDP. As of September 4th, the Atlanta Fed's GDP Now forecast models predicting third quarter annualized growth of 2.1%. So pretty vanilla number is not the right number, but that's about where we expect GDP for the U.S. economy. Now, let's turn our attention to the jobs report. On September 6th, the Bureau of Labor Statistics reported that the U.S. added a disappointing 142,000 jobs in August. The consensus estimate was for 160,000 jobs. And you'll remember this comes on the heels of a very disappointing July jobs report. Unemployment rate is now at 4.2%, and job openings at the end of July were at 7.7%. Let's talk about inflation, which is really much of the focus right now with the Fed meeting coming up. Personal Consumption Expenditure Index, this is the Fed's leading gauge on inflation. On August 30th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.2% in the month of July. For the 12 months ending July, the index was up 2.5%. This compares to 2.7% in March and April, 2.6% in May, and 2.5% in June. So the number is coming down. It's trending in the right direction. It's still not that 2% that the Fed wants to see, so there's probably still some work to go. Let's talk about the Producer Price Index. On August 13th, the Bureau of Labor Statistics reported the Producer Price Index increased 0.1% in July. On a year-over-year basis, the index was up 2.2%. This result compared favorably to the 2.7% increase we saw over the last 12 months in June. So again, trending in the right direction, but not quite there. One more, the Consumer Price Index. On August 14th, the Bureau of Labor Statistics also reported that the Consumer Price Index increased 0.2% in July. This was after falling 0.1% in June. And on a year-over-year basis, the index is up 2.9%. So really another kind of mixed bags of numbers.
Right.
Inflation is coming down. The economy still appears strong from a GDP standpoint, but third quarter GDP is coming in kind of at that 2.1% level. Jobs, disappointing. We are seeing a lot of softness in the jobs market. But overall, we're seeing the good and the bad. But I think this does set up the Fed that now is probably the right time to start an easing campaign. I've got a lot of friends who work for commercial banks, and some of them are pricing in almost 1 full point of decreases in the Fed funds rate between now and year end.
Interesting.
I think that might be a little aggressive. I can definitely see 25 basis points in September and then 25 basis points in December, kind of let that see how it cycles through the economy. As I said, inflation is not where the Fed wants it to be, but I think at this point, the pump is kind of primed. They're ready to do a cut.
Well, the three components that you talked about, GDP, jobs, and inflation, it's all about inflation. And like Cam mentioned, it's kind of a mixed bag where GDP has persistently been better than expected. There's been a lot of talk about a recession and a fear of recession, and the reality is a recession is 2 quarters of negative GDP back to back, and
we haven't seen that.
We haven't seen that. Early in the year, expectations were GDP in the range of 1 to 2% max, and then eventually fall into recession. That hasn't happened. The unemployment numbers, I think is a confusing picture for everyone because it's just, it was persistently stronger than expected, but now revisions are showing, okay, unemployment's softening or employment's softening a bit. But is it because more people coming in the workforce, people that kind of stepped out of the workforce coming in? What's really driving that? There's a lot of mysteries around that. But typically,
to your point,
unemployment softens after you've already been in the recession, so it's usually a lagging indicator. So, a lot of confusion there, but the biggest thing and the reason, the Fed's kind of been hesitant on reducing interest rates is, right now you have the Fed funds rate between 5.25% and 5.5%. Longer term rates, the 10-year Treasury 3.7%. So we're in an inverted yield curve, short term's higher than long term. And the reality is short-term rates kind of dictate a lot of corporate financing. So variable rate loans are hinged on short-term rates. Credit card rates hinge on short-term rates. Home equity loans, short-term rates, which has been elevated, which should be slowing down the economy, or that's the assumption. That's going to slow down the economy. A slower economy should mean lower inflation, which inflation is trending now below 3, or at least all the numbers are below 3. That's good. I wasn't sure if we'd get below 3 or be persistently below 3 by this point, but we have. But so we're approaching that 2 number. And I think the Fed's afraid if they start reducing rates, now that's a little bit more money for a consumer. Corporations face lower financing costs. And I've also heard anecdotal evidence that a lot of corporations are ready to go with a lot of spending.
Which is inflationary.
Yeah, so if we lower rates, things ramp up. Does inflation spike again? Which, the Fed does not want to fall into a late 70s, early 80s situation where inflation spikes up again. So the Fed's in a tough spot right now.
If one thing this Fed has said, and they've preached, that they're going to be data-driven and they're going to be cautious.
Correct.
They do not, to your point, they do not want to get in a situation in the 70s where all of a sudden they cut too aggressively. Now they've got to start increasing rates again because they're seeing inflation. So I think, these 1% talks throughout the end of the year, it seems way too aggressive to me. I see, as I said, 25 basis points in September, 25 basis points in December, and probably a little bit of a pause as we get into the new year to see how the numbers start filtering to the economy, because they do not want to have to reverse themselves.
I can see it being a long process. Just them starting the process, that's the big signal. Does that heat things up? We'll find out. We're in interesting times, and the other piece that Cam really doesn't talk about is, you look at corporate earnings, and second quarter earnings were better than expected. So, and once again, if you reduce rates, that should help corporate earnings, and that filters into what's going on with our investments, especially on the stock side of the equation. Our bonds are driven by interest rates. Yeah, we've been riding the highest part of the interest rate curve there by being short term. And, we'll address that when rates do change. But on the stock side of the equation, year to date, and this is through last month, so this is not taking into account what happened last week, but through August, the S&P was up 18.42% for the year. Dow Jones up 10.28%, and the NASDAQ up 18%. The Russell 2000, which is small cap stocks, 9.4% for the year. And then on the international front, developed world, the MSCI EAFE up 9.52, emerging markets up 7.09. And then last month started off, we started off, with a little bit of a flash crash. I think it was the first Monday or Tuesday of the month. It was the first Monday of the month. The market started a nice, 5% pullback early August. But by the end of the month, the S&P was up 5.65%, Dow was up 4.59%, and the NASDAQ was up 5.59%. Russell 2000, small caps up 5.14, developed international 6.88, emerging markets up 3.31. So everything rallied right on back.
It was a very broad-based
So it turned out to
rally.
be a good month and broad-based, not just driven by, the magnificent seven that we talked about. Those, the largest mega cap tech names weren't necessarily driving things. Things have flattened out, and after that correction, a lot of those stocks have not regained their highs yet. So, a lot of tech stocks are still in correction mode, but the rest of the market is definitely picking up steam. We're seeing good movement from banks, industrials. So that's been a good sign. Our portfolios last month, growth with income fund for the month up 3.7%. Year to date, it's up 14.3%. Big gainers, NVIDIA was actually up 15%. Nike was up 12%. Berkshire Hathaway up 8% in August. Laggards in August, Nucor down 4.7%, Microchip down 4.5%, Disney down 4%. Year to date, NVIDIA, even after being, I think it's over 20% off its highs, still up 141% for the year. Raytheon's up 49%. Lennar, home builder, up 23%. That's picked up some steam even the last couple of days. Berkshire Hathaway up 33%. And then, we've had money in gold. That's up 21% for the year. Laggards, our broad-based commodities, even though gold is up 21%, year to date, our broad-based commodities down 6.4%. And then our real estate ETF is down 4%. In our dividend yield portfolio, August up 4%, year to date up 13.3%. Big gainers there, I mentioned banks. U.S. Bank up 11%, 11.5% for the month. Prudential up 11% for the month. Caterpillar up 11% for the month. Laggards in August, Southern Company down 2%. Kraft Heinz down 1%. Year to date, our big gainers in there, Packaging Corp up 30%. Southern Companies, not Southern Comfort.
Southern Comfort.
It's Southern Companies, which is a utility. They say it was down 2% in August, but year to date still up 27%. Coca-Cola is up 25%. Our only negative in that portfolio year to date is McDonald's, which is down 1.5% through August. Our appreciation with income fund, a newer portfolio. We've only been running this one about 5-6 years. August we were up 3%. Year to date up 19%, so doing real strong year to date. In August, driven by Public Storage up 13%, Philip Morris up 7.5%, Nestle up 7%. Laggards in August, Bungie Corp, which is a food company, down 11%. Mosaic, which is fertilizer, down 3.4%. AES down 1.5%. Year to date, our big gainers, JP Morgan up 35%, Energy Transfer Partners up 24%, Lamar Advertising up 21%. Year to date in the portfolio, our one big laggard, Mosaic's down 12% year to date. Price potential, historically this has been one of our strongest portfolios. This year, just can't get out of its own way.
Yeah.
It's been frustrating, but we kind of have to continue to work the process. I know, over the last, I think it's been probably 15, almost 20 years we've run this portfolio. Rarely, I've never seen a year like this where it's underperformed so much. But in August, regained 2%, year to date up 6%, so we still have a lot of work to do in there. Big gainers last month, Progressive up 17%, Arch Capital Group up 15%, ResMed, which we at the beginning of the month was up 11%. Laggards, Charles River down 19.4%, Owens Corning down 7%, Google down 4%, Genuine Parts down 2.6%. Year to date, still in the portfolio, Interactive Brokers, big gainer for us, up 56%. Arch Capital up 52%. Allstate up 37%. Progressive up 21%. So obviously, financial is doing well in the insurance area. Year to date, Laggards still in the portfolio. Jazz Pharmaceuticals down 6%. Deere down 3%. Small cap stocks, August, the small caps were up. Our portfolio lagged. I mean, we've been well ahead of the game compared to small caps this year. We were down 0.45, almost 0.5% in August. Year to date, still up 17%. Big gainers in the month. IES Holdings up 34%, Hawkins up 23%, Northwest Pipe up 18%, Sterling Infrastructure up 9%. Laggards, Carrot lost about 12%, Kyndryl lost 11%, Blueprint Medicine is down about 11%. Big gainers still in the portfolio, Hawkins up 81%, U.S. Live and Minerals up 79%, Graham up 68%. Laggards year to date still sitting on Procore down 14%, Cast Information down about 10%. So in general, portfolios have performed as expected, except for price potential. Like I said, we continue to try to dig out, kind of catch up there.
But we believe in that one. We believe in the holdings. It's, as you said, it's always the philosophy around the investments has always made sense. It's always worked. It's just for some reason there's a little dislocation with those companies. They're not seeing the fair value we think they should be seeing in the market.
Typically we see a lot of takeovers or takeouts in price potential where you have buyouts and so forth. And we haven't seen any of those this year. So we'll continue to refine our searches and hopefully get that thing moving. But in general, I kind of like the setup going into the end of the year. We've had good momentum up to this point. September, we have to expect some volatility. October, generally not as volatile as September. Obviously going into the election, that causes a lot of uncertainty. But the reality is it's really headline risk. It all comes down to how earnings are doing, how the economy is. And I think we're really setting up for a nice end of the year. Even with the volatility, I think we're going to be higher by the end of the year. And, it's going to come and go for the next couple of months. You have strength into the end of the year and see what 2025 has to hold.
Absolutely. So, as always, thank you very much for the trust you place in us. If you have any questions about your accounts, please feel free to reach out to any member of the Ellsworth team. Thank you.
Thank you.